Hi everyone. Welcome back once again. This is day 4 of the basic class, powered by AJAM's Institute of Forex. In our last class we taught a lot on Forex trading sessions, market overlaps, and Forex terminologies. Today, we will move to currency pairs. Currencies are traded through a broker or dealer, and are traded in pairs, for example, the euro and the US dollar or the British pound and the Japanese yen. When you trade in the Forex market, you buy or sell in currency pairs. Imagine each currency pair constantly in a tug of war with each currency on its own side of the rope. Exchange rates fluctuate based on which currency is stronger at the moment. What are the types of currency pairs in Forex? There are basically three types of currency pairs. 1. Major pairs. 2. Minor pairs. 3. Exotic pairs. Let's start with major currency pairs. The currency pairs listed below are considered the majors. These pairs all contain the US dollar, USD, on one side and are the most frequently traded. The majors are the most liquid and widely traded currency pairs in the world. Some examples of major pairs are euro dollar, dollar yen, pound dollar, dollar Swissy, dollar loonie, Aussie dollar, Kiwi dollar. Take time to study these major pairs and get used to it. Now to the next, minor currency pairs. Currency pairs that don't contain the US dollars are known as cross-currency pairs. Currency pairs that don't contain the US dollars are known as cross-currency pairs, or simply as the crosses. Major crosses are also known as minors. The most actively traded crosses are derived from the three major non-US dollar currencies, euro, Japanese yen, and Great Britain pound. On to the next, exotic pairs. Exotic currency pair of one major currency, paired with the currency of an emerging economy, such as Brazil, Mexico, or Hungary. The chart you see contains a few examples of exotic currency pairs. Wanna take a shot at guessing what those other currency symbols stand for? Depending on your Forex broker, you may see the following exotic currency pairs. So, it's good to know what they are. Keep in mind that these pairs aren't as heavily traded as the majors or crosses, so the transaction cost. Keep in mind that these pairs aren't as heavily traded as the majors or crosses, so the transaction costs associated with trading these pairs are usually bigger. Now let's talk about base currency. Base currency is worth as measured against the second currency. For example, if the dollar Swissy rate equals 1.6350, then $1 is worth 1.6350 Swissy. Having explained base currency, quote currency is the second currency next to base currency. The quote currency is the second currency in any currency pair. This is frequently called the pip currency, and any unrealized profit or loss is expressed in this currency. Like in the picture above, dollar is the base currency while Japanese yen is the quote currency. An important thing to note here is that the base currency is always stronger than the quote currency. Although, there are some few exceptional cases where it is the other way round, whereby the quote currency is stronger than the base, but you don't have to bother yourself about that right now. Although, there are some few exceptional cases where it is the other way round, whereby the quote currency is stronger than the base, but you don't have to bother yourself about that right now. Those are deep concepts of foreign exchange, you don't have to disturb yourself. The trading approach here is, you would buy the pair if you believe the base currency will appreciate, gain value, relative to the quote currency. And you would sell the pair if you think the base currency will depreciate, lose value, relative to the quote currency. We pause at this point, try to digest all you've heard, even if it means going back to day 1. We'll talk on opening a brokerage account later. Goodbye for now, and don't forget to subscribe.